When money markets and high-yield savings accounts are yielding more than 5%, it can be tough to justify putting your money in anything else. And that's what people are doing. U.S. household assets that are being held in money market funds has skyrocketed over the last few years. And for good reason. I mean, it makes sense, right? Why would you accept risk on your money if you can make 5% just having it sit there in cash, essentially? But just because an investment has very low risk of loss, that doesn't mean it's necessarily not risky. I think it's really important to be aware of the unintended risks that may result of an overallocation to short-term investments like money markets and high-yield savings accounts. My name is Michael Carbone. I'm a chartered financial analyst and a certified financial planner in the greater Boston area, and in this video I'm going to explain the investment trap of holding too much of your money in short-term stuff like money markets and high-yield savings accounts. A bond investment is when you lend your money to some institution, whether it's a bank or a government or a municipality or a company. And so when you buy a bond, you're essentially lending them your money. And in return for lending them your money, you're getting paid some rate of interest. Now today, investors that are lending their money for shorter periods of time are making more money, or they're getting paid a higher rate of interest than investors that are lending their money for a longer period of time. So short-term stuff is yielding higher than long-term stuff. The yield curve is inverted. And the yield curve is just a fancy way of visualizing what different bonds of different maturities are yielding so that you can compare the yield that you might be able to get by lending your money for different periods of time. So the horizontal axis is the period of time that you're lending your money or you're investing your bond for until it matures, and the y-axis or the vertical axis is the yield. This is more what a normal upward sloping yield curve would look like. This is what it's supposed to look like. As you can see, 1 month out, you're earning a very low rate of interest. This is a decade ago. As you go out in time, 30 years, you're earning a 3.6% yield on your lending and your bond investments. So this is what it's supposed to look like. The longer that you're lending your money, you should be compensated for that, for lending your money, for committing to lend your money for a longer period of time, right? If you're buying a longer term bond, you would normally expect to receive a higher yield on that investment. So again, why wouldn't you just have all your money or a lot of your money in a money market that's yielding, over 5% when, the alternative is to lend your money for 5 or 10 or 15 years and make, a percent less than that? And it's because short-term bond yields are just that. They're short-term, and they can and they will fluctuate over time as the economy grows and shrinks. So short-term bond yields, just to give you some context, they're largely controlled by our central bank, the Federal Reserve. And so when the central bank is trying to influence the economy, if we have inflation or if we're entering into a recession, they'll use interest rates as a tool to to either stimulate or cool off the economy. And so what you'll find on your screen, you can see these are historical money market yields dating back to the 80s. And so they'll rise sharply and they'll fall sharply. And therein lies the risk of having too much of your money in short-term stuff like money markets and high-yield savings accounts. If yields fall, you're then forced to redeploy that money into a lower interest rate environment. And you might argue that, if money market yields are falling, that, you'll just redeploy that money into, longer term bonds. On the screen, you've got the white line is the 10-year Treasury yield, and the orange yellowish line is the 30-year Treasury yield. And as you can see, although it's not perfect, as yields fall, they generally tend to fall across the yield curve. So all yields tend to fall, and so if your strategy is to redeploy your money, into longer-term bonds, if short-term bond yields are falling, then you're more likely than not going to be redeploying that money into lower yields than what you would have otherwise been able to earn if you had done so before the short-term yields fell. So there you have it. The investment trap of having too much of your money in short-term bonds like money markets and high-yield savings accounts is that these interest rates are short-term, and if they fall to levels that are lower than longer-term bonds, which they are supposed to be, and they typically are, then you'll be forced to redeploy that money into a lower interest rate environment, and the opportunity cost of that can be huge. Money markets can be great investments. They can be great tools for someone that has, their emergency savings that they're looking to, keep in a position that's earning, slightly higher level than what their checking account is earning. But they are intended to be short-term investments. So, if you are overweighted to them and you're waiting for an opportunity, you're timing, the markets, you want to have some dry powder on the side. The point is, they're primarily supposed to be for investments that are, liquid and easy to access. It's just important not to go overboard, to stay balanced, and to remain diversified. But I hope you I hope you found this video helpful. And as always, if you feel like you would benefit from a complimentary consultation with me, I left a link in the description of this video. Feel free to answer just a few questions to see if it might be appropriate to set up a call. But I wish you the very best of luck, and I hope to hear from you soon.